Now, what happens when we compute the net present value of this project when taking into account the full present value of the CCA tax shield? So we have removed the CCA depreciation from the unlevered net income. So now instead of computing EBIT, we have computed EBIT DA. So before not only interest and taxes, but also before depreciation and amortization. And the present value of CCA tax shield is computed as a separate element and added to whatever cash inflow is collected at time zero. And this is how, the cash is not collected at time zero, but in the net present value calculation, this is an amount which value is taken as of time zero. Now, why is it that in this specific example, the full present value of the CCA tax shield has given us a net present value larger than the net present value we have calculated using only the CCA tax shield for the first 5 years? Well, the reason is that when the assets are sold at time 4, there is CCA remaining that will be used into perpetuity. So here the value of the perpetuity does not fall to zero as the assets are sold. Okay, what capital is the CCA depreciation applied to? Okay, so we have the first portion of CCA, which gives us a depreciation of 154, and a second portion that gives us a depreciation of 281. So this is 45% applied to 343 plus 624. So if we add 624 to 343, so that gives $967. So as long as the assets are sold for less than $967, there will be positive CCA remaining in the asset class into perpetuity. If the assets are sold for more than $967, then the remaining CCA will be negative. So the sale of this asset, so the undepreciated asset cost at the beginning of time 5 is $967. If we sell the asset for less than $967, so the difference, $967 plus salvage minus salvage value, will keep depreciating forever. If we sell the assets for more than $967, then not only the first the $7,500 in assets will not continue to depreciate in the asset class, but on top of that, the size of the asset class will be reduced by more than the contribution of the assets that cost the firm $7,500 at time zero. Here's an example. Suppose the assets are sold for $1,000. So $1,000 is larger than 967, which means that when we subtract the contribution of the asset sale to the CCA depreciation that can be used from the $7,500 bought at time zero, it gives us an overall CCA depreciation of minus 15. How can depreciation be negative? This is a capital budgeting problem. So everything is incremental. Sales are increase to overall sales. Cost of goods sold are increases of overall cost of goods sold. And CCA depreciation is the increase in CCA depreciation arising from this project. So if the asset is sold, if the assets purchased at time 0 are sold for $1,000 here, well, the asset class is deducted by an amount larger than whatever these assets contributed to the asset class. So the overall depreciation that that the firm will be able to deduct from this asset class will be $15 less at time 6, $15 less at time 5, $8 less at time 6, and so on. In this case, selling the asset for more than the undepreciated capital cost at time 5 will reduce the present value of the CCA tax shield. So if we compute here with this example, the net present value of the project when we only use the first 5 years, this gives us a net present value of $777. If we take into account the full present value of the CCA tax shield, we obtain a net present value that is lower than the net present value with a fraction of the CCA tax shield, because the full present value of the CCA tax shield computes a reduction in CCA depreciation that will be applied to sales before calculating taxes as of year 5, year 6, year 7, and on forever. So, important considerations. So, in capital budgeting, everything is an increase with respect to existing items on the firm's financial statements. Increase in sales, increase in costs, increase in depreciation. More than one net present value should be computed in every simulation. So one net present value should be computed assuming a higher price of the goods sold, a lower price of the goods sold. So the firm should determine an interval of prices at which the goods produced by this new project could be sold. So it might be a price between $25 and $32. Same thing with variable costs. So net present value should be computed with a range of different variable costs. So variable costs could be 45% of sales, or they could be 55% of sales. Same thing with potential additions to net working capital. Or we have assumed here that sales will be constant over the life of the project. They could go up and then down. We could assume lower sales because of greater cannibalization, or because competitors are doing something more interesting than we do, or they are copying us. So this is scenario analysis or sensitivity analysis. So how sensitive the net present value is to changes in specific assumptions. And finally, when we compare different projects and have to choose between one of them, so we apply the same rules as the ones we have applied when in the chapter on investment decision rules. So we take the project with the highest net present value, or the project with the highest internal rate of return, or we compare both projects, small minus big, and look at the internal rate of return of the difference between I said small minus big, so big cash flow minus small cash flow, compute the internal rate of return of the incremental cash flow of the large project over the small one, and check if the internal rate of return is larger than the company's cost of capital.